Job that I have is more than just a position, it's a passion. And so one of the reasons why it's so important to me goes back to almost 20 years ago when I was in college. And I went to a presentation on Islamic finance. And to give you a summary of what this presentation said on Islamic finance, it said that banking was haram, insurance was haram, investing was haram, and financing was haram. And then once they said this, the speaker, um, after he left, after he came down, he went to his hotel and then he flew back to the country that he was living in. And it dawned on me is that how do we make financial literacy, how do we make financial savings, how do we make retirement work for Muslims here? For Muslims who are trying to build a life here, trying to buy homes here, trying to build business here, that we have to find a way in our religion to make that work. And so that started me on the journey of trying to understand Islamic finance. I worked for a home financing company. Actually took me to Malaysia. I lived in Malaysia, Kuala Lumpur, and I studied Islamic finance for a year. I came back and I took a break, went into corporate finance. And then after that, the last 3 years, I've took this position with Amana Mutual Funds. So that's the first story that really made me so passionate about what I do. The second story was actually working with an auntie of mine. This is a Muslim woman who took her Shahada in 1974. You could imagine what Islam was like in America in 1974. And she decided to wear the hijab. And so she was further ostracized for her family. And so here's this woman who's been practicing Islam, as you could say, against all odds. So fast forward, she asked me to sit down and talk to her about her retirement. And so when I sit down and talk to her about her retirement, she showed me what she was getting for Social Security. She had her home paid off. I said, Auntie, where's your 401k? Where's your 403b? Where's your IRA? She said, I never invested in that because I thought it was haram. So here's this Muslim woman who's been faithful to her religion for 5 decades, and she's going into retirement with like $1,000 in Social Security. And while I know Allah is going to take care of his servants, that there has to be a way for our community to understand that there's a way to invest in their future, but to do so in a way that's aligned with our faith. So this is why the work that we're doing is so important to me. And so just a couple of things before I get started. And also, if we have some sisters here, there are some brochures, my business cards, some pens, and we also have some seeds, right? And the seed packet, it's a bit of a gift, but it's also really reminiscent of what we're doing, of what you're doing when you're investing. You're planting seeds, and you're going to water it, and you're going to water it, and you're going to water it. So inshallah, it will grow. So if you see the seeds, if you see a pens, we have some of the best pens that you will find. And so there's brochures about individual retirement accounts, educational savings accounts, as well as amount of mutual funds. And also, I'm just going to pass this around. This is just a information sheet. If you want me to contact you offline, you can fill this out, leave it with me, and I'll send you an email. In that email, there will be a link to my schedule where we can kind of talk about your own individual investment needs. So you can just pass it around. So, alhamdulillah, we're going to start. We're going to start about Islamic investing. Um, Hopefully, we'll have some time for question and answers. So, to start with, we always have to give the disclosure that investing includes taking on risk, and that risk can involve the loss of capital. And so, when we think about habits of successful investors, I'm only going to touch on a few. The first one is to start early. You're going to see in another slide that the earlier you start, the earlier you have for your money to work for you. Number two, understand diversification. And so, what we're going to talk about today is investing in mutual funds. Mutual funds are a way to get that diversification pretty easily because when you're investing in a mutual fund, you're not just buying one company, you're buying a basket of companies. So, you're buying around 40 companies when you buy one of our mutual funds. And so no longer do you have to look at the risk of one company performing or not performing. You only have that kind of whole market risk, as they say. Why do people save? When you think about why people save for healthcare expense, they save for retirement, they save for the college education, they save for Hajj. The price of Hajj is going up. But what happens if you're planning to go to Hajj in 2028? That's 3 years from now, and it costs $15, and you save $5,000 a year. So what's going to happen in 2028? The price of Hajj is going to go up, right? So saving oftentimes is not enough because prices are going to go up. So being able to save and invest will be able to hopefully not only match, but beat inflation. So when you think about investing, people have a variety of goals. Some is capital preservation, some is growth, some is current income. And so first we're going to talk about investing for college. We're going to talk about retirement. We're going to talk about the Amana mutual funds. And then we're going to talk about strategic giving. And then we're going to have time for question and answers. And I'm going to skip through some of those slides just so we can finish by Isha time. So when you think about the cost of college is almost doubled over the last 30 years, from almost $20,000 in 1992 to over $40,000 in 2022, just for 1 year. And the average college student graduates with over $30,000 in debt. So just imagine that you're starting your young life and you have to carry around $30,000 of debt. And we're going to talk about how you can offset that. So just if you take your fancy cup of coffee that we get, for me, it's a dirty chai latte, which is basically a chai latte with espresso in it, right? If you replace that and take the funds from that and put it over to investing for your child when they're born. So that's $5 a day, $25 a week, $100 a month, and let's just say $1,000 a year. So if you invest that $1,000 a year when your child is born at a 7% rate of return, when they're 3, they're going to have $3,100, right? Not bad. But when they're 18, they're going to have $34,000. So you put in $18,000, it's almost doubled in terms of $36,000. And that's at a 7% rate of return. So that will more than offset the $30,000 in debt that most students are graduating with. And if you think about what are the accounts that you can save for your child, one is called an educational savings account that you put up to $2,000 per year. You don't get a tax deduction, but it will grow tax free. So it's tax deferred while it's growing. And then when you use it for an educational related expense, you won't have to pay any taxes on it. And so you can use it for private school education. You can use it for college. You can use it for room and board. You can use it to buy them a computer. And so you could put in money, $2,000 a year up to the age of 13, up to the age of 18. And then they have up to the age of 30 to use it. And if they don't use it by that age, you can transfer it to another relative. One of the caveats, if you're a high wage earner, right? If you're a high wage earner, which is considered $140,000 if you're single and $230,000 if you're married, then it limits how much money you can put into an ESA. But don't fret, we do have another plan. It's called the UGMA, or Uniform Gift to Minors account. So this account allows you to put up to $18,000 per child per year, per person. So I could put in 18, my wife can put in 18, their grandparents can put in 18. So theoretically, it's unlimited. So this is a taxable account, but the first $1,250, the first $1,250 of taxable income is going to be tax free. So it's a little bit of advantage as well. So the UGMA can be used for anything. It can be used for marriage, traveling around the world. It can be used for buying their first house or their first car. And so the UGMA is another alternative to save for a minor child. The other one that I'm not mentioning is called the 529. The 529 are state sponsored educational accounts, and they allow you to put up to $18,000 a year. The downside about the 529 is that you don't have Sharia compliant investment options. One of the things that we've been doing is we've been working with states to see if they can add Sharia compliant investment options to their lineup for 529s. And if that happens, definitely you'll hear about that from us. And so you can't talk about college without talking about ways to get scholarships, financial aid forms, so on and so forth. And so moving on from college, we want to talk about retirement. And people often ask, well, Hood, if I have, an extra $1,000, an extra $250 a month, should I save for my child's college education or should I save for my retirement? And I'm in the same way. I have six sons, right? And so, even if I have $100, we're going to be splitting that $20 per child, right? And so you're thinking about this. You're thinking about which one do you do? And so one of the things I would say is that there's a few ways to pay for college. They can go to community college. They can get a scholarship. Maybe they got a good jump shot. We see our boys down here playing basketball. There's no other way to save for your retirement except what you put away for it. Number two, the second point is by making sure that your retirement is safe, you're actually taking a burden off of your kids. Because when your kids are young adults, right, if you haven't prepared for your retirement, then you're going to need extra help from them. So taking care of your retirement is also going to make sure that your kids have less of a burdens as they come into adulthood. So the sources of income in retirement, we have personal savings and investments, we have social security, we have pension plans. If you have a pension, consider yourself blessed. They're not being offered anymore. And we have employment during retirement. So the idea is for employment during retirement to be optional, right? We don't want it to be something that our community it has to depend on to make ends meet. And so when you think about personal savings and investing, the ones highlighted, you have real estate, 401ks, IRAs, cash balance plans for insurance. But the ones highlighted in orange, annuities, CDs, and certificate deposits and bonds, are usually ones that are based on interest. And so, what do you think is the average Social Security payment in 2023? Or what was the average in 2023? $1,000? 8,000? 3,000? Okay. Anybody else with a guess? 2,000, right about 2,000. So 1844, right? What does 1844 get you in Allen? Does it get you a three-bedroom? People are looking at me like, not this year, maybe in 1995, right? And so actually the average rental across the whole US is like 1786. So the average rental for a two-bedroom is 1786. So this might be able to pay for your rental. But think about your food. Think about if you want to travel. So we're going to need something in addition to Social Security. So in this illustration, it goes about the need to start early and the power of starting early. So on the left is someone who started investing just $1,000 a year at the age of 25 to the age of 65. On the right is someone who started a little later. They started at the age of 35 and they invested $1,000 a year from age 35 to the age 65. So they invested a total of $30,000. But at the age 65, the person who started at 25 and only invested 10,000 is going to have 112,000. And the person who started a decade later but invested a total of three times as much, 30,000, is only going to have 101,000. So this is the power of starting early. And this is based on a 7% rate of return. This last slide is one of my favorite because it shows the power of investing. It shows somebody who's just starting their career. They're 25 years old. They got their first job and they said, I'm going to invest $250 per paycheck. They get paid twice a month, so that's $500 a year, $500 a month, and $6,000 a year. So if you start that strategy at 25, when you're 65 and ready for retirement, you'll have almost $1.3 million from just that one strategy. And this is based off of a 7% rate of return, too. Hey, but I've been 25, right? You get that first job, you're like, wow, these new cars sure look nice. Mm, they smell nice too. Okay, I'll wait and I'll start investing later. So you start at 35 and you do that same strategy, 250, 500, and $6,000 a year. At the age of 65, you'll only have $606,000. By waiting only a decade, you lost the opportunity cost of over $500,000. So starting early is really important. And if you wait till you're 45, you'll have almost less than $300,000. But when you think about that, when you think about 250, right? That's a lot of money. That's some money I can't use. $500 a month, $6,000 a year over the course of 40 years, that's $240,000, right? So that's a lot of money that came out of your pocket. But you'll have $1 million worth of gain. So 4 times of what you saved, you have in terms of profit. And so this is really important to kind of think about and say, how are we going to invest? And just 2 more points, because I really love this slide. So just 2 more points. The first point is that when you get here, when you get to 65 and you have $1.3 million, right? If we're still talking about a 7% rate of return, you can take out $92,000 a year for the rest of your life in perpetuity. So if you live to 88, if you live to 90, if you live to 100, my wife is visiting her grandmother this weekend. Her grandmother is 103, right? So you can get $90,000 a year every year and still have $1.3 million to either pass on to your family or to be philanthropic and give it to for Sadaqah Jariyah. Yeah, at a 7% rate, if you just take out that 7%. So this is not including inflation. Yeah, no problem. The second one is that it dawned on me that the Quran talks about retirement. I was thinking that retirement is like paradise in a way. People are like, well, like, no, when I retire, I'm still feeling old. I don't feel young. But retirement is like paradise because you just can't show up to retirement, just like you can't show up to paradise, right? They're going to ask, what have you prepared for this? The second way, and people are always asking me, like, where does the Quran talk about retirement? It's in Surah Yusuf. Surah Yusuf uh, gave an interpretation of the Pharaoh's dream. The Pharaoh had a dream that said, I'm 7 fat cows, and it was 7 lean cows, and they devoured the fat cows. And Prophet Yusuf said, alayhi salam said, there will be 7 years of great harvest where you will have plenty, enough to go around. And then you're going to have 7 years of famine. And those famine years are going to outstrip those years of harvest. And this is what we're talking about in retirement, that you have 45 years where you're going to be your most vibrant. You're going to have 45 years where you're going to be making the most money. Most people, most Americans, if you're not 6'6" and have a good jump shot, you're not going to make a lot of money at 22, right? It's in your 40s and 50s where you're starting earning your most money. And so you're going to have 45 years where you're going to be your most vibrant. You're going to have the best earning potential. Those are your fat years. And then you're going to have years where you slow down, where your brain is not working, where your knees are not working. Like, I'm 46 and my back is not working most days, right? And so for those years, you have to have saved something from these fat years for those lean years. So the same thing that Prophet Yusuf is talking about in this dream It's how we set up these retirement plans now. Okay, that's enough for that slide. And so when you think about retirement, there's a couple of accounts. There's an individual retirement account. There's a traditional IRA. It allows you to put in $7,000. If you're above the age of 50, you can put additional 1,000. And the IRA is great because it gives you a lot of flexibility of how do you invest it. In the traditional one, you get a tax deduction when you put it in. It grows tax deferred. And then when you're in retirement and you take out your earnings, then you'll pay taxes on whatever you take out. So that's the traditional. The second one is called the Roth IRA. It has the same contribution limit, 7,000 plus 1,000. For the Roth is that you don't get a tax deduction when you put it in. It still grows tax deferred. And because you didn't get a tax deduction on the front end, when you take it out in retirement, you won't have to pay any taxes. And so about the Roth, two more things is that the contribution that you put in, because it was after tax, you can take that at any time. And secondly, after 5 years, you can take out the profit and the contribution if you have major medical expenses, you file for bankruptcy, God forbid. But if you're buying a house if you're buying your primary home, if you're paying for anyone in your immediate family to go to college, and if you're 59 and a half. So the Roth kind of combines tax deferred investing and flexibility. So a Roth is a great tool to have. But just like the ESA, if you are a high wage earner, 150 single, 230 married, then it limits how much you can put into a Roth. But this is America, so there's always a loophole. So there's a loophole that's called a backdoor Roth, and we can help our shareholders with that as well. In addition to the IRAs, we have the employer sponsor plans. So the employer sponsor plans, 401k, 403b, these plans are great because they allow you to put in a lot more money. So you can put up to $23,000. And if you're above 50, you can have 7,000 catch up. So a total of 30. One of the bad parts about the 401k plan is that they limit your investment options. So you might not find Sharia compliant investment options. Excuse me. So there's two things. One, you can ask your company if they have a self-directed brokerage account. Self-directed brokerage account is where they allow you to self-direct your IRA, self-direct your 401k plan. Number two is after you leave a company, you can roll your 401k plan into an IRA. And so that will allow you to have a lot of investment options. You know, this is one of the things that we do for our shareholders. A lot of folks will have a 401k and they will roll it. And I really think is a good idea because what you see is you'll see that if you're 50 years old, maybe you had three different positions, and maybe you worked somewhere 15 years ago and you probably have $5,000 in the 401k and you haven't looked at it in years. And so instead of forgetting about your money, roll it over into an IRA with a provider that you trust, so you know it will be your account. So okay, so we're going to move on and talk about the Amana mutual funds. Talks about what it means to be an Islamic investment company. The first thing is that you have to have an outside reviewer, Sharia supervisory. You have to have scholars who are going through and saying, we're looking at what they're doing, and what they're doing is aligned with the Quran and Sunnah. We use a company called Amani Advisors. They're based in Malaysia. They also have offices in the Gulf. And they review our portfolio quarterly, and they give us a Sharia certificate on an annual basis. And so what is the certificate? What is the review about? So the first thing, it looks at the primary business of the company. So if it's pornography, alcohol, gambling, casinos, banks, insurance companies, we're not going to invest in it, full stop. Additionally, we also added if it's a weapons manufacturing, if it's Boeing, if it's making guns, we're not going to invest in it. Additionally, we have to look at some of their financials. So we look at their balance sheet and say, how much debt do they have? We look at their balance sheet and say, what's the type of assets they have? Their accounts receivables has to be less than 45% of their total assets. And these are US companies, so they're going to have impermissible income. So the impermissible income from a secondary or tertiary source has to be less than 5% of their total income. A quick example, Southwest airplane company, not a big deal, but they sell alcohol. So you will have to do the due diligence and say, hey, how much alcohol revenue do they have? And the alcohol revenue has to be less than 5% of their total revenue. So we do this, and we're able to, and we're not, for all of our companies, we're nowhere near 5%, because if it gets over 5%, we have to sell it. So for usually our companies are 1 to 2%. And while the expense ratio you pay on your fund is purifying it from impure income, we also have a purification calculator on our website where you can put in the number of shares and they'll tell you how much income you need to purify from that fund. In addition to being the Sharia criteria, we're also ESG, because it's not enough to not do what God said not to do, but we should think about our relationship as Khalifa or stewards. So we think about environmental, we think about sustainable, we think about governance, and we have a proprietary ESG score that we take through all of our companies that we invest in. So we have 4 mutual funds. The 4 mutual funds, they're stacked in order of risk. So at the bottom is the Amana Participation Fund, low risk, low return, right? It's for capital preservation. We're going to see the returns in a second. One level up is Amana Income Fund. This looks at large US companies that are paying a dividend. So these companies are usually relatively stable. One level up, we look at the Amana Growth Fund. The Amana Growth Fund is our best performing fund. And it looks at companies, large US companies who are primed for growth. And then at the highest level, we look at the Amana Developing World. So we have 2 domestic mutual funds, and now we have an international one so that our shareholders can get exposure to the international markets. Now, if we look at our returns, you have to have a benchmark, because if you don't have a benchmark, then I can tell you I'm going to give you a 10% return and you might be happy, but you'll go outside and Bilal is getting a 22% return and you're going to be like, what's up with that? And so our benchmark is the S&P 500, the largest 500 companies in the US. And so for real life figures, if you invested $10,000 in the Amana Income Fund in 2014, it will be worth $25,695 in 2024. Our benchmark, the S&P 500, if you invested $10,000 in 2014, it'll be worth $33,000 in 2024. And our growth fund, at $10,000 investment in 2014, will be worth $41,000 this year in 2024. So you can see that the growth fund outperformed the market. The Amana Income Fund was a little less than the market. And so those figures, the Amana Income Fund, the average return over the last decade was 10.2. Compare that to 12.9 for the S&P 500. And the Amana Growth Fund was a 15.6% return over the last decade. Looking at our other 2 funds, the Amana Developing World was right around this benchmark, right around 3% over the last 10 years. And the Amana Participation Fund was at 1.5, so a little less than the benchmark. So that's the one that's supposed to be kind of low risk, low return. Also, in addition to opening accounts with us, so you can open a ESA, you can open an IRA, you can open a general investment account. All those accounts can be opened with a minimum investment of $100, and they can be opened online. So it takes probably about 15 to 20 minutes. You have my business card. You can come talk to me. It's really easy to open. In addition to that, 2 services that we offer is that we offer financial planning. Oftentimes, you might be in your 30s or 40s or 50s, and you're thinking about, hey, am I on track to retire when I would like to retire? And so the financial plan is going to help you understand to how to get from where you are to where you want to be. And so we do this free of charge. We're looking, it makes the most sense for people who already have kind of retirements or assets around $100,000. That way we already know where you are now and we can give you a clear picture of where you need to go. We also do individual managed accounts. So sometimes we have people who want to be a little bit more aggressive than our funds or focus on more income than our funds. And so we can do an individual managed account with you, give you your own portfolio manager. Um, but we're looking for account size like $1 million and above. The last thing we want to talk about, and I think we have some time for Q&A, is strategic giving. So one of the things that's important is like, how can we be more efficient in our giving? I think one of my goals as working in this industry, and you're working in this wealth industry, so you're working with people might have 1 million, might have 2 million, might have more, alhamdulillah. But our goal is not to create wealthy Muslims. Our goal is to create philanthropic Muslims, because what good is wealth if we're not using it to get closer to Allah? What good is wealth if we're not using it to please our Lord? And so we want to create philanthropic Muslims. And so we want Muslims to understand the best of knowledge of philanthropic, best of knowledge of what an institution such as Islamic Association Allen can do, not just to help themselves, but also to help their donors. So a couple of strategies. The first one is called a donor advised fund. So like say you're an entrepreneur or you had a good year and you are going to have tax problems, right? And so, what a donor advised fund will allow you to do is to make a big donation in 2024. So, like, say, I want to donate $50,000 to a donor advised fund. And then it allows me to invest that money and also use it for charitable causes over the next 5, 10, 15, 20 years or more. So it's almost like creating an endowment or a waqf for your family or for yourself. So it's a way to give money now and also spread that out. So for example, you might have a good year and you put $100,000 in it. And then for the next 10 years, you can pay your zakat from that fund and give it to Islamic Associated Allen, give it to Maruf Dallas, give it to Islamic Relief, give it to Muslim Aid USA, so on and so forth. So a DAF is very easy. We don't create DAFs. We work with American Muslim Community Foundation. They'll create a DAF and then they'll invest it with us so that it's earning more money so you can even be more charitable. The second one is donating appreciated stocks. So like say that you had a like just a stroke of genius and you invested in Nvidia 12 months ago, right? You're probably not here because you're probably at home counting how much your stock went up. So if you invested in Nvidia 12 months ago, you're gonna be looking pretty good right now, right? And say that you want to make a donation to the Allen Masjid. And so instead of donating cash or instead of selling that Nvidia stock, paying a hefty capital gains tax, you can donate those stocks directly to the masjid, and the masjid, the 501c, can receive it. And when they sell it, they won't have to pay any capital gains. And so it's a really a strategic a way of donating. And the Allen Masjid has that brokerage account to receive donated stocks. And so you can donate those. You'll get the tax write-off for the appreciated value. You'll save on capital gains tax, and the masjid would benefit from it. In addition to that, the Allen Masjid actually has an account where they can receive Amana mutual fund shares. Alhamdulillah, we have been investing with Muslims since 1986. So in every community we go to, we find someone, and I talked to someone today who said, hey, I've been investing with y'all for 5, 10, 15, 20 years. And so folks can donate those shares directly to Allen Masjid, right? and get the full write-off value of those appreciated shares. Because our shares of our mutual fund is right around $70 today. But 20 years ago, it was $10. So you can donate those shares to the master. So that's the second one. The fourth one is required minimum distributions. So if you're 73, you are going to be required to take out money from your traditional IRA or 401k. And it's depend on your age, so on and so forth, that you're required to take out money. Alhamdulillah, we have people in our community who really don't need the money in their IRA. Maybe they have other investments, maybe they have real estate income, and they just say, like, I don't need this money. But the government wants you to take it because for the traditional IRA, you put it in pre-tax and it grew without tax. So the government, Uncle Sam, has been waiting to tax you. And so instead of, if you want to keep Uncle Sam away a little bit longer, so instead of taking the money, you can donate those required minimum distributions to the Alan Masjid, to a 501c3 that you care about, right? You're not going to get a write-off, but you've never taken that money, and so you won't have to pay taxes on it. So it's a way of kind of avoiding to pay tax on income you don't want. And in most cases, you're probably already going to be charitable, right? There was a poll, I think it was ISPU, that the Muslim community was the most charitable community, right? So we're already going to be charitable. We already have to give zakat. And so by giving it through the required minimum distributions, you won't have to take it and then pay taxes on it. And the final one is just to think about a trust or a will. And so when you're creating a trust is almost it's one step beyond a will, because a will, you have to go through probate. It's going to be a public. A trust can happen automatically upon you passing, and you can bequest in that trust a donation to a masjid of your choice or an organization of your choice. And it's a way of really being philanthropic and really being giving, even after we pass away. So I think, do we have a bit of time before prayer? Yeah, I think we have probably about 5 minutes. This is a QR code. I have business cards outside. If you scan the QR code, you can go to all of my contact information as well as my schedule, and you can set up an appointment. But I think we have a few moments for questions. And then I'll also be around here after Isha. I think we also have pizza coming uh, as well. Assalamu alaikum. Very good question. So the question was, why does the Amana invest in stocks like Amazon? And so for us, we looked at companies like Amazon, but Amazon is a retail company, right? Now it's probably a technology company, but it's a retail company. So its main line of business is retail, and that retail includes selling alcohol. So once Amazon decided to start selling alcohol, we couldn't even own it in our fund anymore. So that's one of the reasons why we don't own Amazon. And it's the same way for most retailers that also sell alcohol. It's interesting because people often ask me about other jurisprudence. Some other companies will look at Amazon and say, hey, Amazon is a retail company, but their retail is smaller than their technology. And their alcohol retail is minuscule. So it'll go under their 5% rule. And so for this one, we're almost a little bit more stricter on this scale. And so we're choosing not to invest in Amazon. I think so. The debt level? Yeah. So how do we determine that? So that's a great question. How do we? Yeah. So that's a great question. So when we started in 1986, there wasn't a Sharia compliant index for stocks. We actually made it up. So we said, okay, we don't want pork, we don't want alcohol, we don't want this. But then the scholar said also, you don't want companies with debt. And so we looked at companies that had zero debt, and the companies that had zero debt were actually two banks. So we're like, we can't do that. And so the scholars kind of debated and came to kind of a consensus over what is that debt level that will be okay and be tolerable. One of the things that we do share is, the scholar Tucky Usmani, he has a chapter in his book, Intro to Islamic Finance, that he talks about the debt ratio, he talks about the accounts receivable, so he talks about all three. But part of that was trying to come up with a consensus of where should those lines be drawn. That's a very good question. Do we invest in cryptocurrency? So not at the moment. And the reality is that the crypto market is not heavily regulated. And so, we are investing, folks who've been teachers for 25 years. We've been investing money for folks who are just general average American Muslims. And so we want to be ultra prudent in our investments. And so we're never going to be the first ones to the party. We're going to be a little late and make sure that our investments are something that we really feel strongly about. So right now, all of our investments are in publicly traded companies here and abroad. Yeah, so the Dow Jones Islamic Index is something that Iman Fund works with. So Iman Fund is another mutual fund uh, that is similar to Amana mutual funds, but they also like benchmark itself against the Dow Jones Islamic Index. Uh, I don't think Sheikh Kardawi is part of either of the two right now. He might have been in the past. No, we were working with the FIC Council of North America and ISNA. Mhm. That's a very good question. So, Southwest is a great just analogy of that 5% rule. We don't invest in we don't invest in Southwest in any of our portfolios. But I haven't heard our portfolio managers talk a lot about, hedging. But, usually, we have the Sharia criteria, and then we have the environmental, sustainable, and governance criteria. But that's a new one. So we've been talking to Michigan, we've been talking to Washington State, we've been talking to, maybe four or five states, and each state picks who they want to run their 529 plan. And so we've been kind of reaching out to states to say, you have a sizable Muslim population. You should really think about adding some Sharia compliant options. So I know we worked with Michigan. I know we worked with the state of Washington. And if there's contacts at other kind of 529 plans, we have a whole team that kind of reaches out to them because, the 529 plan is the ESA is older, so the 529 is newer and allows you to put in more money. And so we are anxiously hoping to get some traction on kind of. And then the good thing about a 529 is that you don't have to go with Texas. You can go with Michigan or Virginia or Alabama, so on and so forth. There's a question right here. So it's $18,000 per year per child for the 529, and that's kind of across the country. Usually people just do the 529 in their state unless there's a reason to do it in another state. But how it works is that you can do, as a Texas resident, you can do a 529 in any of the 50 states. So the hope is if we go to a state like Michigan that has a sizable Muslim population, if we can get them to add Sharia compliant funds, and then they see that Muslims in Texas and Vermont and DC are all going to Michigan, that other states will also follow suit and give their residents some Sharia compliant investment options. So, inshallah. No, so you can use a 529 in any state. Some states will give you an additional kind of, like, for example, Texas, in addition to having the 529 investment option, they have a 529 prepaid tuition. So you can kind of prepay your tuition for state colleges as well. So alhamdulillah, thank you for inviting me. You know, I live in Richardson, so I live close by. My kids play basketball here. So if you ever see me, definitely give me salams. I love to kind of work with you all, inshallah. And I'll also send you an email, inshallah. So thank you. Assalamu alaikum wa rahmatullahi wa barakatuh.
الله أكبر الله أكبر الله أكبر